Now, I want us to look at the FA question that is for CPA and August paper of 2022, question number 3. This is a manufacturing account. So the question reads, Majimatamu Limited manufactures Tamu juice. On 1st January 2021, 100,000 liters of Tamu juice were in the stock. During the year ended 31st December 2021, the company manufactured 366 liters of juice. The company sold 400,000 liters of juice at a price of 600. The following trial balance was extracted from the books of the company for the year ended 31st December 2021. So we have the trial balance from ordinary share capital way down to bank, which is an overdraft. So additional information states number 1, inventories, that is the closing, raw material, work in progress, finished goods. Then allowance for doubtful debts is maintained at 5% of accounts receivable. Then as at 31st December 2021, accrued factory expenses amounted to 125, including office expenses of 75. Prepaid factory expenses amounted to 12,000, including rent and rents for 7,000. And then you have depreciation, factory building, that is at cost 2%, factory plant 20, motor vehicle 25. The inventory of finished goods of Tamu juice on 1st January 2021 was valued at factory cost. The directors of Majimatamu decided to transfer all Tamu juice manufactured to the warehouse at a markup of 10%. The directors proposed a dividend of 10%, 10 shillings per share. So we're supposed to make a manufacturing statement or a statement of profit and loss. So I'll highlight around 3 columns here. So the first thing is the name of the company, Majimatamu. So the second one column is the statement that we're preparing. So that is manufacturing. And statement of profit and loss and loss, profit or not or loss. So first we'll just try to enlarge, and then we need to have currencies in Kenyan shillings, thousands, also Kenyan shillings, thousands, we need to add another column here. We're preparing this statement for what period? So say here for the year ended, that is 31st, for the year ended 30th June 2022. 30th June 2022. So the normal format for manufacturing, you must have the concept of how it is developed. So we normally start with raw materials. Raw materials. Raw materials, we have opening inventory. Opening inventory. So opening inventory of raw material were given in the trial balance here. Raw material opening inventories here. 3280 here. Then we need to add the purchases. We need to bring in, not even just adding, just bring the purchases. This also raw material. Purchases of raw material. Now the purchases of raw material in regards to our question that was given in the trial balance here, purchases of raw material. So that is 166,101. 166,101. And then we need to bring in, we need to add, if it is there, add carriage in. So in the question we didn't have the carriage in works here. There's none. It should be in the trial balance. And then we need to less return out. Lesser return out. If it is there, return out. In our question we didn't have it. So I'll bring the values here. You add the 3. So it maintains 166,101. Then this is we call it raw material. Raw materials are available for use. So you add the opening bar classes, the 166,101. And then we need to less closing inventory. That is also raw material. So when we less the closing inventory raw material, which was given in note number 1, that is 3560. So this will give us what you call raw materials consumed. So that is 169,381 minus the closing inventory. So up to there we have the raw material consumed. Then after having the raw material consumed, then we need to add direct expenses. So the direct expenses, these are expenses that are incurred directly for production and can be attributable to the final product, can be able to be attached directly to the final product. So in our case, we need the direct expenses that we have is only factory wages. Factory wages. Now, the factory wages, we've been given in the question factory wages here. Factory wages, that is 3810. 3810. So we bring in 3810 here. So that is the only direct expense that is there. So once you add that, we get what we call prime cost. So that is equals to 165,821 plus 3810. So that is giving me 161,631. That is the prime cost. So it's like a heading there. Could bold that. Raw material available for use, also I bold it. And then raw material consumed, also I bold that. Yeah. Then we need to add the factory overheads. So these are the indirect expenses of the factory. So one of the indirect expenses, we have just the factory expenses. The first thing there is the factory expense. Factory expense. Factory expense. Factory expense. So you check how much have we been given. So the factory expenditure here, factory expenditure, that is 3860 first. So you bring here 3860. And then there was a note number 2 that had an adjustment in regards to factory expenses. So note number 3. So we have factory expenses accrued 125, including 75 of office. So we remove 75, but we need the factory, that is 50. So plus 50. Then there is prepayment, what you paid in excess. So the prepayment, so the prepayment still on that prepaid expense of 12, and then out of that you have office of 7. So that is 5. So you need to knock off 5. So that will give us the factory expenses. So when you look at the factory expenses, they pick the right value, the factory expenses. Factory wages, then you have factory salaries, then you have factory expenses, office expenses. This is office expenses. I picked office expenses rather than factory. You have to be keen so that you pick the right one. So the 3860 is the office expense, but I wanted the factory expenses, that is 13490. Yeah, so I change that 13490 here. So it gives me 535 as my factory expense. Then there's another expense of factory, which is the depreciation of assets used in the factory. So we need to bring here depreciation. So the first depreciation is factory building. Factory building. Now, for the factory building, we are told it is 2%, but it should be factory building alone. When you come to factory, there is land and building, and land is 11. So the remaining goes to the factory building. So that is 22,700. We subtract, that is 22,700. Subtract the 11,000. Then now we compute 2% times 0.02. So I'm getting 234 as my depreciation. Then you have the next one is the factory plant. Factory plant. oh, factory plant there. So factory plant, factory plant, the cost is 35,000, and then we need to compute 20%, 20% of 35,000. So 0.2 times 35,000. So it is giving me 7,000. So I don't think there is any other. So we get the total cost of production. So we add from prime cost, that is 169, 631 plus 13,535 plus 234 plus 7. So I'm getting 190,400. After getting the 190,400, we need to add the opening work in progress. And opening work in progress we were given directly from the question also. Opening work in progress is here. That is 11,000. Then we less closing work in progress. And the closing work in progress also been given in the question. The closing work in progress here is 18,400 here. 18,400. So when you sum up the work in progress, we get now the factory cost of production. Factory cost of production. Factory cost of production. So you adding the total production cost of production plus opening work in progress less closing work in progress there. So that is giving me 183,000. So production cost here bold, factory production cost also bold. But now this factory production cost of production could be the transfer if the goods are transferred at cost. If not, there's normally a profit that is supposed to be added. So we normally add factory profit, and the factory profit we were given in a note. The directors of Majoritamu transfer all the tamu is manufactured at warehouse at a markup of 10%, so 10%. So this is equals to 0.1 times the factory production cost, 83. So we get now what we call the transfer cost. Transfer cost, which includes the profit for the factory. So that is 183 plus 18,300. So I'm getting 201,300. So this is now the transfer cost and their finished goods or finished goods. So that is the manufacturing. They wanted it together with the trading account, so the trading profit or loss. So we proceed, we just keep a single line. So we have sales. We also take the value given of sales in the trial balance, 276,831. 276,831. Then you need to less cost of sales. The cost of sales is opening. We have opening inventory inventory, in bracket those are finished goods, finished goods, and opening inventory were given directly from the trial balance. Finished goods, that is 50,000 here, 50,000. Then we need to add the goods transferred, cost of goods transferred, goods transferred, and the goods transferred is just given here. What we have worked here is the goods transferred that I'm taking to replace. Under the normal trading, it could be like the purchases, but they don't purchase final products. We produce and then sell. Then we need to less closing inventory. Now the closing inventory also is given in the additional information. That is not number 4, number 1. That is 33,000 here. So we less 33,000. So we get our cost of sales here. So we're supposed to subtract the sum of these three. So I'm getting to 18,300. So the difference with the sales will give us the gross profit. So the 276 minus 218 to give us a gross profit, I'm having 58,531. Then we need to add other incomes here. Add other incomes. So the first income that we need to add is the factory profit. So I'll pick it direct. That was 18,300 here. So this is the value that I brought. So the 18,300, that is the value that I brought as factory profit. Then we need to look at the provision for bad debt. If there is an increase, it is an expense. If there is a decrease, it is an income. So here we have provision. So I could say provision for bad debt. So we have the balance brought down. So that is what is in the trial balance directly. So balance brought down from the trial balance, allowance for doubtful debt here, that is 380 here, 380. So you need to compute now the balance now carried down, and the balance carried down will be told is 5%, because that is in note number 2. Allowance for doubtful debt is 5% of the receivable. So 5% of the receivable, which is 4340 times 4340. So I'm getting 217. So you compare whether there is an increase or a decrease. So this automatically a decrease. So the 380 minus 217. So there is the provision carried down, that is receivable was how much? Am I picking the right value? The accounts receivable here, I picked payable 4320. It is supposed to be 5340 here. 5340. So this is 5340. I picked the wrong value here. 5340. So 267. So there is an increase of there is a decrease of 113. So a decrease, it becomes an income. So here you put decrease in provision for bad debt. So that is 113 there. So you pick this directly. So 113. So once we have that, then we have our total incomes. Total incomes. So we add from gross profit. I've written wrongly. I'll correct that. Gross profit plus factory profit plus decrease in provision. So this is supposed to be profit. So total incomes. So after getting the total incomes, that is 76,944. So we have to look at now the expenses that we have. So the expenses that we have, we have the expenses of we have the expenses there. We need to list now the expenses here. So less expenses, less expenses. So we need to just begin on the expenses. We pick all expenses that we have not included in the production. Because once you have that, then automatically we will have our right value of expense. So the value of sales is 276,381. We have to begin. This is 381. Yeah, I've done transpose here. 381. 381. So you have to begin with the value so that you don't interchange the values, because if you interchange it will mess like everything. So we less the expenses. So the expenses that we have first expense, the unrealized profit. Unrealized profit. Profit. So on the closing inventory, this 33 has a profit in it because it was transferred as part of the good that were transferred at a profit, which was 10% on cost markup. So we need to work out that unrealized profit, because that will be now 10 over 110. You multiply with the closing inventory of 33,000. So which is if I put it here, that is 10 divided by 110, 110, then times 33,000. So it is giving me 3,000. That is the first item. Then we look at office expenses. Office expenses. Office expenses. Now, our office expenses, we check in the balance. Office expenses, that is the 3810. Now this 3810 we adjust with note number 3. There was an accrual of 75. So 30 office expenses 3860 is what we have. Office expenses 3860 here. So that is the first thing I need, 3860 plus accrual. Accrual, which was office expense 75, minus prepayment. Prepayment, that is office, is 7. So it is giving me 3928. Then we need to bring in depreciation for motor vehicle. Depreciation for motor vehicle. So depreciation for motor vehicle is 25% of the cost, and the cost of motor vehicle is 4050. 25% of 4050. So 0.25 times 4050 times 4050. So I'm getting 1012.5. Then after that we have office salaries. We didn't touch this, so we pick it. Office salaries. So office salaries we pick directly also. Office salaries is the 1250 here. So we add these expenses, we need to subtract here. So when you sum up the expenses, so I'm getting 9190.5. So once you have that, we need to get now the profit before tax. So that is the total income minus expenses here. Then we need to less tax. Tax we've not been given, so we assume it's 0. Then you get profit after tax. So that is the before minus tax. Then we need to less dividends. So dividends, you come to the question here. There was a note number 7. Directors have proposed a dividend of 7 shillings per share. How many shares do you have? We have 40,000. So we knock off the 3 zeros because we're cancelling, and then times 10. So that is 240 and then times 10. So we need to less this. So we'll get the retained profit for the year. Retained profit for the year. So we subtract the 2. So you have the retained profit for the year here. And then we need to add retained profit brought down. The retained profit brought down we given in the question, that is the item here, 3,000. So we get the retained profit, profit carried down. So you add the two. So that is the case of our statement, the income statement. So next we need to do now the statement for financial position. So the statement of financial position, also you need to know the format, what to put where and when. So the first thing we need is to have the name, the company. So here, because I have it already, I'll bring it here. Then I need to indicate I'm preparing the statement. What am I supposed to prepare? This is a statement of financial position. Of a financial position. So this is as at 30th June 22. So we put up the two columns. We have cost, depreciation, then net book value. So shillings in thousand still, also shillings in thousand. What do we have? Shillings in thousand again here. So we can put columns in thousand, columns in currency form, accounting. So we start with assets. So the first asset we start with the non-current assets. Non-current assets, remove the E there. Then for the non-current assets, you have the first item, that is factory, land and building. Factory, land and building. So the cost is 22,700. Depreciation, we want the current year depreciation of factory building here. Factory building depreciation, this is 234 plus the other accumulated depreciation in the statement, the trial balance, which is factory building is 7680. So net book value, we take the cost minus the accumulated depreciation. Then the next item, that is plant and machinery. Plant and machinery. So the cost of plant and machinery, cost is 35,000. So bring in 35. Then the depreciation computed, that was 7 plus the provision in the trial balance, plant and machinery, 2930. So again we get the book value. Yeah. So we're getting 25,070. Then we have motor vehicles. So we have motor vehicles. So motor vehicle, that was 4050. Again we bring in the depreciation of motor vehicle, which was thing in the trading account, the profit or loss, yeah, 1012.5, but we need to add on the provision for depreciation in the motor vehicle. The provision for motor vehicle here is 950. That's what we add, 950 here. So we subtract again, we get the net book value. Then we sum up the book values. So I'm getting 41,943.5. Then I come to current assets. Current assets. So we start with the current assets. We start with the inventories, which is already given there. So the first thing is inventories. So on the inventories, we have raw material. So the raw material, the closing inventory of raw material is given in note number 1, 3560. Then the next we have work in progress. Also given at the same point where we had raw material, 18400. Then we have finished goods. Now finished goods, we have the same point, but we need to knock off the unrealized profit that we've recorded in the income statement. So the finished goods, that was 33,000 here. So 33,000 minus unrealized profit that we've recorded in the income statement. Unrealized profit, we got 3,000 here. So 33 minus 3,000 remains 30. So that is the inventory. Now apart from inventory, we have accounts receivable. The accounts receivables, check the trial balance also. Receivable is 5340. So 5340 minus the provision, which is carried down here. So what I'm subtracting is this provision, 67 to 67. So I remain with 7053. Then we had prepayments. Prepayments was in the same general. The prepayment is 12 here as an asset. 12. So we add. So 3560 plus 18400 plus 3000 plus 5073 plus 12. So then we sum up together total assets. So that is equals to 41 plus 57,045. So those are total assets. the other side should balance on the same. So this side is for equity, equity, equity and liabilities. Liabilities. So the first thing we need to bring is the ordinary share capital. Ordinary share capital. Capital. So the ordinary share capital we pick directly from the statement. The first item, 24,000. Then we have now the retained profit. Retained profit. So retained profit, we picking what you have as the last item in the statement, the retained profit carried down here, the 67. Yeah. So the current the equity that you have. Then we need to bring in current liabilities because we did not have non-current liabilities. So we have current liabilities. So current liabilities, the first thing is accounts payable. Accounts payable. So the accounts payable also we just picked directly from the statement. That was among the last item here. That is the 4320 here. Then we have also bank overdraft. Bank overdraft. The bank overdraft was given directly, was the last item in the trial balance, that is 240. And then we have accruals. Accruals, I think it was in note number 3. So accruals, this is 125. So bring 125 here. 125. Then we have now the ordinary dividends. Dividends, because they have not been paid, it is proposed dividends. So we pick also from our statement. It was on the income statement. Dividends, this is 24. But I need to make it a positive here. Yeah. So we add the 4 items. So I'm getting 70 for 85. So we have the total equity, and liabilities. Total equity, and liabilities. So you just need to add the 3 items, that is share capital plus retained profit plus current liability, so which gives us the same value. So we have to be able to develop this. So the main key thing is the effect. What are you supposed to prepare? How are each statements affected? So once you're able to know the effect of each step on each statement, then it becomes easier for you to prepare these two key statements. That is the statement of manufacturing and statement of profit and loss, and then now the statement of financial position. So that is what was required of this particular question.